Listen to me very carefully. There are over 10,000 cryptocurrencies out there right now. 10,000. And I'm about to tell you why 99.9% of them are absolute garbage that will destroy your wealth. I only own two, Bitcoin and Ethereum. That's it. And if you're holding anything else, you're lighting your money on fire. This isn't my opinion. This is cold, hard data about how crypto markets actually work and how smart investors position themselves to capture gains without exposing themselves to catastrophic losses. I'm Kevin O'Leary. I've built companies from nothing and sold them for hundreds of millions of dollars. I've seen every financial bubble in modern history, .com, real estate, and now crypto. I was skeptical of crypto for years, but I studied it. I invested in it. I made money in it, and I lost money in it. And what I learned is that most people in crypto are gambling, not investing. They're chasing meme coins and tokens that have zero fundamental value. That ends now. Now, let me set the stage for you. When crypto started, Bitcoin was the only game in town. Then Ethereum launched and brought smart contracts to the blockchain. That was revolutionary. But then something happened that destroyed more wealth than any market crash in history. The floodgates opened. Thousands of new tokens launched: meme coins, dog coins, celebrity coins, NFT projects, DeFi protocols, layer 2 solutions, gaming tokens, metaverse coins, 10,000 different cryptocurrencies, all competing for your money. And you know what happened? People got destroyed. 95% of these tokens went to zero, not down 50%, not down 70%, zero. Completely worthless. People who put their life savings into Luna lost everything overnight. People who bought FTX's token because Sam Bankman-Fried told them it was safe lost everything. People who chased the latest meme coin because some influencer on social media pumped it lost everything. This isn't theoretical. This is real money, real people, real devastation. I've received emails from people who lost their retirement funds chasing altcoins. I've talked to investors who thought they were diversifying by owning 50 different cryptocurrencies, only to watch 48 of them become worthless. Here's the brutal truth that nobody wants to tell you. The crypto market is not like the stock market where you can diversify across sectors and reduce risk. In crypto, diversification into random altcoins doesn't reduce risk. It increases it because most of these tokens have no underlying value. No utility, no adoption, no future. They're just speculative vehicles designed to transfer money from retail investors to insiders who created the token. You might be thinking, but Kevin, what about the projects that have real technology? What about the ones solving real problems? Let me be very clear. Technology doesn't matter if nobody uses it. Adoption matters, network effects matter, liquidity matters, and when you look at the data, only two cryptocurrencies have achieved the network effects, the institutional adoption, and the liquidity that make them legitimate financial assets: Bitcoin and Ethereum. Everything else is noise. I've been in business for 40 years. I've seen hundreds of companies with amazing technology fail because they couldn't achieve market adoption. I've seen brilliant entrepreneurs with revolutionary products go bankrupt because they ran out of money before they found customers. Technology is necessary but not sufficient. You need adoption. You need staying power. You need network effects that create defensible moats. That's what Bitcoin and Ethereum have. That's what the other 10,000 tokens don't have. And that's why I changed my entire crypto strategy to focus exclusively on these two assets. Now I'm going to tell you exactly why I only own Bitcoin and Ethereum and why this strategy captures over 90% of crypto's upside while eliminating 99% of the downside risk. There are three fundamental reasons that make this the only rational crypto strategy for serious investors. Let's start with the numbers, because the numbers don't lie. Bitcoin's market cap is approximately $1.3 trillion. Ethereum's market cap is approximately $450 billion. Together, they represent $1.75 trillion in market capitalization. The total crypto market cap is roughly $2.5 trillion. Bitcoin plus Ethereum are 70% of total crypto market cap, 1.75 T of 2.5 T. Do the math. Bitcoin and Ethereum represent 70% of the entire crypto market by value. But here's what most people don't understand. When you look at price movements and volatility, Bitcoin and Ethereum capture over 90% of the alpha, the excess returns of the entire crypto market. What does that mean? It means when crypto goes up, Bitcoin and Ethereum go up. When crypto goes down, Bitcoin and Ethereum go down. but they do it with less volatility than the altcoins, and they do it with massive liquidity that allows you to actually exit your position if you need to. Let me give you a concrete example. In the 2021 bull market, Bitcoin went from $10,000 to $69,000. That's a 590% return. Ethereum went from $400 to $4,800. That's a 1,100% return. Now, yes, some altcoins did better. Some went up 10,000%, but 95% of them eventually crashed back down and never recovered. 2021 bull run. Bitcoin up 590%. Ethereum up 2,100%. Smart investors captured the 500 to 1,000% gains in Bitcoin and Ethereum. They locked in profits. They preserved capital. Gamblers chased the 10,000% gains in random altcoins. Most of them gave back everything and ended up with nothing. Here's the principle. You don't need to own every horse in the race to profit from horse racing. You need to own the horses that actually win consistently. Bitcoin and Ethereum are the only horses with proven track records of surviving multiple cycles, maintaining liquidity, and delivering returns to long-term holders. When I analyze any investment, I ask myself, am I getting adequately compensated for the risk I'm taking? With Bitcoin and Ethereum, the answer is yes. I'm exposed to crypto market gains with manageable risk. With altcoins, the answer is no. I'm exposed to catastrophic loss risk with only a lottery ticket chance of life-changing gains. That's not investing, that's gambling. And I didn't build wealth over 40 years by gambling. I built it by making disciplined, data-driven decisions that maximize return per unit of risk. Now let's talk about what's happening right now in the institutional world, because this is where everything changes. For 12 years, Wall Street sat on the sidelines. Banks couldn't touch crypto. Pension funds couldn't allocate. Insurance companies couldn't invest. Why? Regulatory uncertainty. Nobody knew if crypto would be classified as a security, a commodity, or something else entirely. That's changing. We now have Bitcoin ETFs approved by the SEC. BlackRock launched a Bitcoin ETF that accumulated over $20 billion in assets in less than 1 year. Fidelity has a Bitcoin ETF. ARK Invest has a Bitcoin ETF. These are not fringe companies. These are the largest asset managers in the world bringing Bitcoin to mainstream investors. BlackRock's Bitcoin ETF accumulated 20B plus in under 1 year. And it's not just Bitcoin. Ethereum ETFs are launching. The SEC approved spot Ethereum ETFs in 2024. Institutional money is flowing into Ethereum because Ethereum is the infrastructure layer for decentralized finance, stablecoins, and tokenized real-world assets. Here's what you need to understand. When institutions allocate capital, they don't buy meme coins. They don't buy tokens created last week by anonymous developers. They buy assets with regulatory clarity, deep liquidity, and proven track records. That's Bitcoin and Ethereum. Nothing else qualifies. The Stablecoin Act that's being discussed in Congress right now is a game changer. For the first time, the United States is moving toward clear regulatory frameworks for crypto. And what blockchain do stablecoins run on? Ethereum. USDC, the second largest stablecoin with a market cap of over $50 billion, runs primarily on Ethereum. Tether, the largest stablecoin with over $140 billion in circulation, runs on Ethereum and other chains. But Ethereum dominates. When financial services go on-chain, and they will, they're going to use Ethereum. Not some random layer 1 blockchain that nobody's heard of. Not a token created by a project that's been around for 6 months. Ethereum has the developer ecosystem. It has the security. It has the network effects. It has the institutional trust. I've been in negotiations with banks and financial institutions exploring blockchain technology. Every single one of them is looking at Ethereum or Bitcoin. None of them are looking at the flavor of the month altcoin that crypto Twitter is pumping this week. This is not a prediction. This is already happening. JP Morgan is using blockchain for repo transactions. Goldman Sachs is exploring tokenized assets. BlackRock is tokenizing money market funds. All of this is happening on established blockchains with regulatory clarity and institutional adoption. That's Bitcoin and Ethereum. If you own altcoins, you're betting against institutional adoption. You're betting that retail speculation will continue to drive prices forever. That's a losing bet. Institutions control trillions of dollars. When they enter a market, they determine what wins and what loses, and they've already decided. Bitcoin and Ethereum win. Everything else is a sideshow. Now, let me tell you about the third reason I only own Bitcoin and Ethereum. And this one is huge. You can generate income from these assets without selling them. You can earn yield. You can get monthly distributions. And you can do it with significantly less risk than lending your altcoins to some random DeFi protocol that's going to get hacked or go bankrupt. Here's how it works. With Bitcoin, you can lend it to regulated institutions that pay you interest. You can use it as collateral for covered call strategies that generate premium income. With Ethereum, you can stake it directly on the Ethereum network and earn approximately 3 to 4% annual yield just for holding it and securing the network. Ethereum staking yields approximately 3 to 4% annually. But here's what's really powerful. You can combine Bitcoin and Ethereum in structured strategies that generate monthly income while maintaining exposure to price appreciation. I use these strategies personally. I'm earning yield on my crypto holdings every single month, and I'm doing it with assets that have deep liquidity, institutional support, and regulatory clarity. Compare that to gold. I like gold, I own gold, but gold doesn't generate yield. You hold gold, you pay storage fees, and you hope it appreciates. With Bitcoin and Ethereum, you hold the asset, you earn yield, and you participate in price appreciation. That's a superior risk-adjusted return profile. Now, you might be thinking, but Kevin, can I earn higher yields by lending altcoins or providing liquidity on DeFi protocols? Yes, you can. You can also get much higher returns by gambling at a casino. The question is not what's the maximum possible return. The question is what's the maximum risk-adjusted return, accounting for the probability of losing everything. I've seen what happens when DeFi protocols collapse. Celsius Network offered 18% yields on crypto deposits. They went bankrupt. Depositors lost billions. BlockFi offered high yields. They went bankrupt. FTX offered yield products. They went bankrupt. Voyager Digital offered high yields. They went bankrupt. Multiple major crypto lenders collapsed in 2022, 2023. When you chase high yields in crypto, you're taking counterparty risk with entities that are often unregulated, undercapitalized, and over-leveraged. When the market turns, they blow up, and you lose everything. With Bitcoin and Ethereum, you can generate reasonable yields, 3 to 6% depending on strategy, with regulated counterparties or through decentralized staking that doesn't require you to give up custody of your assets. That's smart. That's disciplined. That's how you build wealth over time without blowing yourself up chasing returns. Let me tell you a story from my own experience. When I was building my education software company in the 1990s, we had salespeople who wanted to offer massive discounts to close deals. They'd say, Kevin, if we just give them 60% off, we'll close this huge contract. And I'd say, at 60% off, we lose money on every customer. This isn't a business, this is charity. The same principle applies to crypto yields. If someone is offering you 20% yields when the market rate is 3%, they're either taking massive risks with your money or they're running a Ponzi scheme. Neither scenario ends well for you. Smart investors take the market rate of return on high-quality assets. They don't chase unsustainable yields on risky assets. Bitcoin and Ethereum let you earn reasonable yields on institutional-grade assets. That's the only way to play this game without eventually getting destroyed. Now, let me reinforce why this two-asset strategy is not just smart, but essential for anyone serious about crypto investing. I want to go deeper on each of these three reasons and show you why every alternative approach is fundamentally flawed. Let's go back to the market alpha argument. When I say Bitcoin and Ethereum capture 90% of crypto's alpha, I'm not making that up. That's based on correlation analysis of price movements across the entire crypto market. When Bitcoin moves, the market moves. Every altcoin trader knows this. They watch Bitcoin dominance charts. They watch Ethereum's price action. Why? Because Bitcoin and Ethereum are the market. There's a concept in finance called beta. Beta measures how much an asset moves relative to the overall market. Bitcoin is the market in crypto. It has a beta of 1 by definition. Ethereum has a slightly higher beta, meaning it moves more than Bitcoin in both directions. Altcoins have extremely high betas. They move wildly relative to Bitcoin. Here's what that means practically. If you own Bitcoin and Ethereum, you get the market return. If you own altcoins, you get the market return plus or minus massive idiosyncratic risk. The risk that your specific token goes to zero, regardless of what the overall market does. That's not diversification, that's concentration risk disguised as diversification. I learned this lesson the hard way. In the 2021 bull market, I bought some altcoins. Not a lot, but some. I bought tokens that had interesting technology, teams that seemed credible, use cases that made sense. And you know what happened? Most of them crashed 70 to 90% and never recovered. Even as Bitcoin and Ethereum eventually recovered and made new highs, my altcoins stayed dead. That's when I realized I was making the classic mistake. I was confusing interesting technology with investable assets. Just because something is innovative doesn't mean you should own it financially. I see the same mistake in venture capital all the time. Entrepreneurs pitch revolutionary ideas, but most revolutionary ideas fail. The ones that succeed are the ones that achieve product market fit, scale, and network effects. Bitcoin achieved product market fit as digital gold and a store of value. Ethereum achieved product market fit as the infrastructure for decentralized applications and financial services. Everything else is still searching for product market fit, and most of them never will. Now let's talk more about institutional adoption because this is accelerating faster than most people realize. I have conversations with family offices, pension funds, and endowments exploring crypto allocations. Every single one asks the same questions. Which assets have regulatory clarity? Which assets have deep liquidity? Which assets can we actually buy in size without moving the market? The answer is always Bitcoin and Ethereum. Nothing else meets institutional investment criteria. You can't build a $200 million position in some random altcoin without causing massive price slippage and becoming a whale who can't exit. With Bitcoin and Ethereum, institutional-sized positions are normal. Daily Bitcoin trading volume exceeds 30 by most altcoins under 100 hours. Think about that. Bitcoin trades over $30 billion per day in volume. Most altcoins trade under $100 million per day. If you're managing $1 billion fund and you want to allocate 2% to crypto, that's $20 million. You can deploy $20 million into Bitcoin or Ethereum without moving the market. Try deploying $20 million into an altcoin and watch what happens. You'll move the price 30% on the buy and crash it 50% when you try to sell. Liquidity is everything in investing. It doesn't matter how much your asset appreciates on paper if you can't sell it when you need to. I've seen people sitting on massive paper gains in illiquid altcoins who couldn't sell because there were no buyers. By the time liquidity returned, their gains had evaporated. Bitcoin and Ethereum have liquidity 24 hours a day, 7 days a week, across hundreds of exchanges worldwide. You can enter and exit positions at any size at any time. That's what makes them investable assets rather than speculative tokens. Now let's talk about the regulatory environment, because this is where the separation between Bitcoin, Ethereum, and everything else becomes crystal clear. The SEC has been very aggressive going after crypto projects, calling them unregistered securities. Dozens of tokens have been sued, exchanges have been forced to delist assets, projects have shut down, but Bitcoin and Ethereum have regulatory clarity. The SEC's chair, Gary Gensler, has explicitly stated that Bitcoin is a commodity, not a security. The CFTC regulates Bitcoin futures. Ethereum transitioned to proof of stake, and the SEC has allowed Ethereum ETFs to launch, signaling acceptance of Ethereum as well. SEC approved spot Bitcoin and Ethereum ETFs in 2024. That regulatory clarity is priceless. It means institutional money can flow in without legal risk. It means you can hold these assets in retirement accounts. It means regulated exchanges and custodians will support them. Compare that to altcoins, where you're constantly wondering if the SEC is going to declare them securities and force exchanges to delist them. I've invested in businesses that got shut down by regulators. It's catastrophic. You can have the best product in the world, but if regulators decide you're operating illegally, you're done. In crypto, that risk is enormous for altcoins and minimal for Bitcoin and Ethereum. That's why I don't touch anything else. Let me talk about the yield generation piece, because this is where Bitcoin and Ethereum really shine compared to other assets. Gold is the traditional safe haven asset. I own gold. but gold has a cost of carry, storage fees, insurance, transportation. You pay to hold gold. It generates no income. Bitcoin and Ethereum generate income. With Bitcoin, you can participate in covered call strategies through regulated products. You sell call options against your Bitcoin holdings and collect premium. If Bitcoin stays below the strike price, you keep the premium and your Bitcoin. If Bitcoin rises above the strike price, you sell at a profit and you keep the premium. It's a win-win for generating income. With Ethereum, staking is even simpler. You lock your Ethereum in the staking protocol. You help secure the network, and you earn 3 to 4% annual yield paid in Ethereum. There's no counterparty risk because you're staking directly on the blockchain. Your Ethereum never leaves your control. It's locked, but it's yours. Compare that to lending your crypto to centralized platforms. When you lend to a platform, you give up custody. You're trusting them not to lose your money, not to get hacked, not to make bad bets with your assets. And as we saw in 2022 and 2023, that trust was misplaced for dozens of platforms that collapsed. I don't take counterparty risk when I don't have to. With Ethereum staking, I don't have to. I earn yield directly from the protocol. That's safe. That's sustainable. That's how you generate income in crypto without exposing yourself to catastrophic risk. You might be asking, Kevin, what about proof-of-stake altcoins that offer 10 or 15% staking yields? Here's the problem. Those high yields are usually inflationary. They're paying you in newly minted tokens that dilute the supply. If the token supply increases 15% per year to pay staking rewards, and you earn 15% staking yield, you're not actually making anything. You're just keeping pace with inflation. Ethereum's staking yield is deflationary in many market conditions. Ethereum burns transaction fees. When network activity is high, more ETH gets burned than minted. That means the supply decreases while you're earning yield. That's real return, not just keeping pace with inflation. This is the difference between smart crypto investing and gambling. Smart investors look at token economics. They look at supply dynamics. They look at whether yields are sustainable or inflationary. Gamblers just see a big number and buy. Let me tie this back to fundamental investing principles. When I invest in anything, stocks, real estate, businesses, crypto, I ask 3 questions. First, does this asset have durable competitive advantages? Second, does it generate cash flow? Third, can I exit this position if I need to? Bitcoin and Ethereum answer yes to all 3 questions. Durable competitive advantages, network effects, developer ecosystems, institutional adoption, cash flow, staking yields, lending yields, covered call premiums, exit liquidity, 24/7 trading, deep order books, institutional grade custody. Most altcoins fail on all 3 criteria. No durable advantages because any new project can copy their code. No sustainable cash flow because their yields are inflationary or dependent on unsustainable user growth. No exit liquidity because trading volume is thin and concentrated on a few exchanges. That's why I only own Bitcoin and Ethereum. They're the only crypto assets that meet my investment criteria. Everything else is speculation masquerading as investment. Let me bring this all together for you because this is about your financial future and making sure you don't get destroyed chasing the wrong strategy in crypto. I only own Bitcoin and Ethereum for 3 fundamental reasons that are based on cold, hard data, not hype or emotion. Reason 1, Bitcoin and Ethereum capture over 90% of the total crypto market's alpha. They represent 70% of total market capitalization and dominate price movements across the entire space. When crypto goes up, they go up. When crypto goes down, they go down. But they do it with liquidity, institutional support, and significantly less risk than altcoins. You don't need to own 10,000 different tokens to get crypto exposure. You need to own the 2 assets that define the market. Reason 2, institutional adoption and regulatory clarity favor Bitcoin and Ethereum exclusively. The SEC approved Bitcoin and Ethereum ETFs. BlackRock is managing billions in Bitcoin. Financial services are moving on-chain using Ethereum. Banks, pension funds, and family offices are allocating to these 2 assets and nothing else. When institutions control trillions of dollars and they're only buying Bitcoin and Ethereum, that tells you everything you need to know about what has staying power and what doesn't. Reason 3, Bitcoin and Ethereum generate yield without sacrificing liquidity or taking catastrophic counterparty risk. You can earn 3 to 6% annual returns through staking, covered calls, and regulated lending while maintaining exposure to price appreciation. Compare that to gold, which generates no yield, or altcoins, where high-yield products have repeatedly collapsed and destroyed billions in user funds. This is not complicated. This is discipline. This is data-driven decision-making. This is how you build wealth in crypto without gambling your financial future on tokens that will likely be worthless in 3 years. Most people fail in crypto because they get greedy. Like they see Bitcoin go up and they think, I missed it. I need to find the next Bitcoin. So they buy random altcoins hoping for 100 times returns, and they lose everything. Smart investors don't chase the next Bitcoin. They own Bitcoin and they own Ethereum, and they let institutional adoption and network effects do the work. I've been investing for 40 years. I've seen every bubble. I've seen every crash. And I've learned that wealth is built by owning high-quality assets for long periods of time, not by gambling on lottery tickets. Bitcoin and Ethereum are the only high-quality assets in crypto. Everything else is noise. Here's what you need to do. Audit your crypto portfolio right now. How much do you have in Bitcoin and Ethereum versus altcoins? If you're holding meme coins, gaming tokens, DeFi tokens, or any of the thousands of random altcoins, you need to ask yourself a simple question. Why do I own this instead of more Bitcoin and Ethereum? If the answer is because I think it could go up 100 times, that's gambling, not investing. Sell those positions, consolidate into Bitcoin and Ethereum, protect your wealth, build a strategy that's sustainable, liquid, and backed by institutional adoption. Don't wait for the next altcoin collapse. Don't wait for your tokens to get delisted. Don't wait for the project you own to shut down. Act now. Simplify your portfolio. Focus on the only 2 crypto assets that matter. Now I need you to do a few things for me before you click away from this video. First, smash that like button if you found this valuable. This information could save you from losing your entire crypto portfolio to worthless altcoins. Show me that you're paying attention. Show me that you understand why Bitcoin and Ethereum are the only crypto assets worth owning. Second, share this video with your friends and family who are investing in crypto. Most people don't understand what they're doing. They're buying random tokens because someone on social media told them to. They need to hear this message. They need to understand why focusing on Bitcoin and Ethereum is the only rational strategy. Send them this link right now. Third, leave a comment. Tell me what you think. Tell me what percentage of your crypto portfolio is in Bitcoin and Ethereum versus altcoins. Tell me if this video convinced you to simplify your strategy. I read the comments. I want to know what's on your mind. This is a community of serious investors who make data-driven decisions, not emotional gambles. Fourth, if you haven't already, subscribe to this channel. Hit that subscribe button and turn on notifications. I release videos regularly about crypto investing, protecting your wealth, and making smart financial decisions in this market. The information I share here is worth thousands of dollars in losses avoided. Subscribe right now. Fifth, consider becoming a member of this channel for exclusive content. Members get access to deeper analysis, portfolio strategies, and direct Q&A sessions where I answer your specific questions about crypto investing. Click the join button below this video to learn more. We're building a community of disciplined crypto investors who understand that wealth is built by owning high-quality assets, not by chasing meme coins and lottery ticket altcoins. We're not gamblers. We're investors. We make decisions based on data, fundamentals, liquidity, and institutional adoption. When I look at the members of this community, I see people who get it. People who understand that Bitcoin and Ethereum are the only crypto assets with institutional adoption, regulatory clarity, deep liquidity, and sustainable yield generation. People who are willing to ignore the noise and focus on what actually matters. If that's you, then join us. Subscribe, engage, learn, build your wealth the smart way. And remember what I told you today. I only own Bitcoin and Ethereum. Not because I'm conservative or because I don't understand other projects, because I've studied the entire crypto market for years, and these are the only 2 assets that meet my investment criteria: network effects, institutional adoption, regulatory clarity, liquidity, yield generation. Everything else fails on at least one of those criteria. You don't need to own 10,000 tokens to participate in crypto. You need to own the 2 that matter. Build that position, dollar cost average over time, earn yield where possible, hold for the long term. That's how you build wealth in this market. Don't chase altcoins. Don't gamble on meme tokens. Don't get destroyed by the next Celsius or FTX or Luna collapse. Own Bitcoin and Ethereum. Protect your wealth. Position yourself for the institutional adoption wave that's already happening. Stay smart. Stay disciplined. And remember, in crypto, discipline beats greed every single time. The market rewards patient, strategic investors who own quality assets. It destroys gamblers who chase quick riches. I'll see you in the next video where we'll talk about exactly how to earn yield on your Bitcoin and Ethereum holdings safely and sustainably. Until then, protect your wealth and live the life you deserve.